Let's start with Google. Here's Lee with an email. Google shares were falling as of late, although they've been up lately. Can your guest comment on the reason, and is this a buying opportunity?
So first of all, the internet stocks as a group have underperformed recently. There's been some profit taking place. Facebook has behaved better than many others. But I think at this point, one of the concerns is how much revenue is out there and available for online advertising. Google certainly has had its share over the last few years, but there is rising competition coming from others. Certainly Facebook's doing a better job. Certainly some of the other folks are doing a better job. I think that there's been a lot of investment in different properties. I would say in general, we are seeing a little bit of money move more toward slightly more economically sensitive names than these, and those with pretty strong free cash flow generation. So we'll have to see. We're coming into year end. There has been some profit take, some tax loss selling recently. It's not one of the stronger names in the market, and from a sector perspective, just doesn't appear to be the best neighborhood to be in.
Are you still in Apple?
We are in Apple.
Yeah.
We are in Apple, and it's one of our bigger holdings. And it'll be interesting to see how it trades post year end. A lot of portfolio managers want to make sure they've got it in the portfolio for year end. So I think that if I were a buyer of Apple, I'd probably like to get through year end and see how it opens the year in January, see if there's any profit taking. But Apple's really executing it in the middle of a great product cycle.
There's Apple against Google the last year. Where else do you have technology exposure?
We have exposure in a number of areas. We're focused in software, semiconductors, which is sort of the new copper. If you think the economy is getting better, you should own semiconductors and semiconductor equipment. We're in security software. Clearly, there's lots of online threats right now, and the companies that are doing a good job dealing with that are doing well. We're in some old line hardware, like Hewlett-Packard and Intel, specifically just for the really strong balance sheets and improvement in cash flow. We have about over 20% of our equity portfolio would be technology related, but in a variety of different areas.
Right. Okay, let's get to energy. There's Hewlett-Packard up to 2.2% today. Sean's in Toronto. Hi, Sean.
Hi, good afternoon. This is regarding Canadian oil sands. I'm wondering if this is the worst case scenario company for the energy sector, but is moving up and up and up. I wanted to know what is the reason.
Thanks, Sean. Is this sort of a, what do you want to call it, technical rally we're seeing in energy?
Yeah, I mean,
here?
it's had 2 days of a bounce off the lows. And I think that you have to just think about this. The nature of a bear market is steady dripping declines marked or punctuated by short, sharp rallies. Mm-hmm. Okay, and the short, sharp rallies very often are driven by short covering. We had a little bounce in oil yesterday, the day before, held, and you had a move in the producers for 2 days. And in percentage terms, it seems like a big deal. When you look at it relative to the recent price movement, it's a drop in the bucket. Now, maybe it is that there's a trading rally setting up here, and that's very possible. I've just found in general it's not a great idea to pick bottoms. And if you are going to try and pick a bottom in a sector, you want to go with the company that has been performing the best in the index, not the worst, because that's the most likely recipient of new buyers. And Canadian oil sands just doesn't meet that test.
What's at the top of your list? CNQ, Suncor?
I think if you had to buy something, probably a CNQ. We have not tried to catch this bounce in the last couple of days. I want to see whether it holds or not. We do think it's likely energy prices are going to stay down here for a while. But, some of the pressure on tax loss selling will come off these things, and it's very possible you get a bounce into the beginning of the year. It's more of a trade than a long-term secular change for the better. And so I think that that's not the place to really stake your claim for next year.
Let's talk to Jim. He's in Pickering. Go ahead, Jim.
Hi, good afternoon, Mark and David. I'm starting to feel like the canary in the commodity market, and I mean oil in particular. And, it led me to think this way, David, is that I'm starting to think, and I'm asking about Canadian banks, I'm starting to think of them as a consumer staple. I mean, we just all need them. And what I've done all right in commodities over the years, but it's that collapse, it's the gyration. So I'm just thinking, getting your opinion on Canadian banks for next year and beyond.
Great.
Thank you.
So, Jim, to your point, there's a lot of people recognizing that when they say cyclical, they're cyclical for a reason when you talk about energy stocks. And we just hit that point where there's a little excess supply and a little slowdown in demand. The banks, I think, are set up for the environment that's coming at us as a sector globally. I will say that in the short run, the headwind for the Canadian banks is, what kind of impact would a weak oil market have on the Canadian banks, who in many ways have been involved in funding the oil companies and the growth in production. So I think that if you're looking at the banks, you've got to pick your spots. And so the way we look at it, I think probably Royal Bank is about the most attractive because it has such a large wealth management business. And in a good market, and we're in a good market, I think, probably over the next year, they should continue to gain market share and continue to do really well as markets get better. The other bank that we would like would be TD Bank, and that's because they have such a great footprint in the U.S., and they're actually doing a really good job of executing in the U.S., and we think the U.S. economy will be stronger than the Canadian economy. If push comes to shove, however, I would suggest probably more looking at a U.S. bank where you probably get a little bit better dividend growth, you've got an improving economic environment, and where their balance sheets are much, much better and they're more likely to be able to start paying a little bit better dividends, so like a Wells Fargo, for instance.
Wells Fargo. Okay, David, a short break here. More questions after this.